Hello everyone. Do you know that if you have extra cash in your broker, there is a strategy that could bring you some extra pocket money consistently every month? If we could manage this method well enough, this method may even retire us earlier when we manage to build our capital large enough. This method could also bring you some free shares. Hello everyone, I'm Jay from JM Investment Journal. In this video, the strategy that I'm going to introduce is cash secured put strategy. My aim for this series is to record my journey to collect enough premium that is more than my monthly salary so I could retire myself earlier. Please subscribe my channel and turn on the notification bell if you would also like to retire earlier in the stock market as well. Disclaimer. As this is the very first video of my selling option for pocket money series, part 1 of this video, we will start with a very brief introduction on the option. Option is a contract between buyer and seller to buy or sell a stock at an agreed price and date. The price that agreed by each party is called strike price. The date is called the expiration date. It simply means that on the expiration date, the buyer of the option has the right to exercise or execute the option at the agreed strike price or not. Later, I will give an example of when the buyer will exercise his right. One option contract represents 100 shares of a stock. There are two types of option, call option and put option. Call option gives the buyer the right to buy the shares at the strike price on the expiration date. For example, current stock price is at $48. You expect the price will be going out 1 month later. Then you purchase a call option at the strike price of $50 by paying a premium of around, let's say, $10. 1 month later, if the underlying or the stock price is at $52, based on the option contract with the seller, we have the right to exercise this option by paying $50 per share per option, instead of buying the same amount of stock at $52. In this case, as one option has 100 shares, so our profit will be 52 minus 50 times 100 equal to $200. Of course, we need to minus off the premium that we pay. That is around $10, right? So the net profit will be $190 for this case. Okay, let's say, what if the stock price now is at $44? Are you still willing to pay $50 to buy a share that is now at $44? If you exercise this contract, right, you will lose $600 per option. Net loss will be $610 if we include the premium. Of course, I don't think you will do this, right? So we will just tear this option contract, and this option will expire worthless. In this case, our total loss will be only the premium that we pay, that is $10. After talk about call option, let us talk about put option. Put option is the opposite to call option. I purchase a put option if I think that the stock price is going down. Using the same example as above, the current stock price is at $48. I purchased a put option at a strike price of $46 with a premium of $10. 1 month later, the stock price is at $44. Now, we have the right to exercise the put option. In this case, I can short sell the stock at $46 per share per option. Or I'm borrowing 100 shares from the broker at $46 per share. As the current stock price is at $44, right? I can simply buy back the same amount of share at $44 and return the share to the broker. In this case, my profit will be 46 minus 44 times 100 equal to $200. Of course, we need to minus off the premium that we pay. My net profit will be $190 for this case. However, what if 1 month later, the stock price is at $52? If I exercise my option, I will need to buy the shares back at $52 to return to the broker. Therefore, I will suffer a loss of 52 minus 46 times 100 or $600 per contract. Net loss will be 610 if I include the premium paid. Of course, I'm definitely not going to exercise it. I will tear this option, so my loss will be only limited to the premium paid or $10 only. Summary: if we buy a call option, we profit on a call option when the stock price increases. We pay a premium. We have the right to exercise the option to buy the stock at the strike price. Call option is more valuable when the price increases. If we buy a put option, we profit on a put option when the stock decreases in price. We pay a premium. We have the right to exercise the option to sell the stocks at the strike price. Now, please take your pen out and record this because this is very important. The buyer will only exercise a call option if the strike price is below the stock price at the expiration date. The buyer will only exercise a put option if the strike price is above the stock price at the expiration date. Okay, for all the examples that I mentioned just now, it's based on the buyer perspective. Obviously, we can also short sell a call option or put option. As a seller, we will receive a premium. Yes, you are right. The moment we sell an option, either call or put option to open our position, instead of paying our money for the premium, now we are receiving the money. If we short sell a call, we would like the stock price to go down. If we short sell a put, we would like the stock price to go out instead. As a short seller, we always sell to open at a high premium price and buy back at a lower premium price, or we just let it expire worthless. However, as a seller, we are obligated to honor the option if the buyer exercises the option. The key word here is obligated. Because as a buyer, right, if the stock price moves against us, we can just tear the option and we only lost the premium that we pay. However, this is not the case for seller because we are obligated to honor this option. If a call option is assigned, as a seller, we are obligated to sell 100 shares per option at the strike price. If a put option is assigned, as a seller, we are obligated to buy 100 shares per option at the strike price. By the way, please also note that in US stock market, the buyer has the right to exercise the option prior to the expiration date. Okay, hopefully you're still not so confused on put and call option and the perspective for buyer and seller. By the way, this is a summary table from what I have shared so far. Hopefully, this summary table could help you. Feel free to screenshot or note down on your notebook if you need. Please rewatch this part until you understand the basic concept of the option. Next, let us zoom into put seller. Just to remind you the most important concept here, the buyer will not exercise a put option if the strike price is below the stock price at the expiration date. This is the example. The current stock price is at $48. I sell a put option with a strike price of $46. As a seller, I receive a $10 premium from the buyer. 1 month later, if the stock price is above $46, we know that the buyer will not exercise a put option if the strike price is below stock price. Therefore, the option expired worthless, and we do not need to pay a single cent to buy it back. As the result, we will pocket the premium. That's why I call this pocket money. Now, let us see another scenario. What if the strike price falls below $46 on an expiration date? The buyer will only exercise a put option if the strike price is above the stock price at the expiration date. Now, we know that as a put seller, if the stock price falls below the strike price, we are obligated to purchase 100 shares per option of the stock at the strike price. If we do not have enough cash to buy the shares, we may be called for margin or forced to borrow money from the broker, or even the broker will liquidate our other positions to purchase these 100 shares. This would be a disaster as the stock may continue to drop. In this scenario, the risk is very, very high, and this is called naked put seller, and this is what we need to avoid. However, if we have enough cash to buy the shares, we do not need to use any margin. In this scenario, it is called cash secured put seller. Why cash secured put strategy is a very good strategy to use? First, most of the time, we are waiting for a price of a stock to go to our buying level. During this period, instead of just waiting, we could simply sell a put option with a strike price at our preferred buying level. If on the expiration date, the stock does not reach this strike price, we could just pocket the premium. However, if the stock price dropped to our buying level, we could just buy the shares as we wish. Second, we can get the share for free if we close the position earlier to collect the profit, or the option expired worthless. At this stage, we have confirmed to collect the money and put them into our pocket. So we could use the premium collected to buy the share. By doing so, we could collect the shares for free until it reaches our buying level. For instance, if I sell a put option and collect a premium of $50, after the option expired worthless, if the share price is at around $45, then we can use the premium collected to purchase one share of the stock. Third, time is our friend. The premium of option consists of both intrinsic value and extrinsic value. The time decays is affected by a factor called theta. In this video, we are not going in depth for theta and the intrinsic value. In brief, because of the time decay, the extrinsic value of an option also decreases with time. As we are an option seller, the more the extrinsic value decays, or when the time passes, the more pocket money we could collect. I classify 5 potential movements for a stock price. It goes out slightly, consolidation or no direction, goes down slightly, or it goes down. I will explain this in my demonstration of a real trade using Snap. Basically, as long as the stock does not go down or get down a lot, we could collect the profit for the others 4 directions. Hopefully at this point, we have learned something new. Please remember to subscribe our channel and also turn on the notification bell, because I will be also keep updating on my strategy on the cash secure put or other option strategy that I have experienced myself. Okay, let's talk about my rules for cash secure put strategy. The first one, we must have enough cash to buy back the shares if assigned. Second, the stocks that we selected must be fundamentally sound, so we know that the temporary stock price decline is because of the retracement, that eventually they will be going back out. Please avoid those pump and dump stocks or those speculative stocks that you have not confident enough on their fundamental. For example, this one, and this one. This stock, right, if you are assigned, they may be just die over along the time and you will lose a lot of money. I'm also going to share my 3 rules that are optional. They are good to have, but it's not necessary. Choose the strike price slightly lower than the support level. I will be illustrate this in my demo later. Sometimes I prefer the stock with weekly option because it can provide us more time flexibility and also rolling if required. The option should also have enough open interest or volume. We need the liquidity to open and close the position at a reasonable price. Okay, I'm going to demo how I sell a Snap put option to collect the premium. Snap is one of my favorite stocks in selling the option. First, let us identify where is the potential support for the Snap. So recently, the Nasdaq sell off, right? We can see that the lowest point for Snap is around $51 here. So let us mark here. then you can see a very strong bin bar here. So that means that $51 is a good support. So if we extend this line, right, we can also see that $51 is also quite near to MA 100. So I would be happy to buy share at this point. Please also take note that the structure of snap chart, right, is not very nice at this moment because there's a potential head and shoulder pattern is showing here. So this is a very important support because let's say if it clash or below this support, right, it may go all over to 43. Okay. So let's say we are going to look for the premium of 10 if we sell the option at $51. Let's go to trade. Okay, so this is a snap option. Then we can check the IV over here. Okay, then if we from here, right, we found that we can see that at 23rd April, after 35 days, the IV is quite high for this one. So we will expect some juicy premium here. Okay, go to all strike. So we see $51 here, right? So it's quite good here, the premium. If we sell at this point, we will be able to obtain the premium around $200 or $300. Okay, let us see the previous week. $50 is around 100 something, the premium we can collect. Remember, we need to times 100 for the option. So let's say I'm more comfortable to get the premium for around $200. So this $48.5 seems is a nice premium to collect. Let us see where is 48.5. Go back to the chart. Then $48.5 will be around here. Then we can extend to the left. Okay, then we find that, right, this price is also at a very nice support here. Okay, so I'm more comfortable at 48.5. The premium is also good. Okay, so let's do this. So I'm going to sell the option at $48.5. Okay, 48.5. This is a put option. Okay, so I click bid because I'm the seller, so I will click at the bid side. 220, 230. Then see, well, this price is failed. Just click confirm and send. Okay, so how to see this? So this will be this is a strike price, $48.5 put. Okay, because I'm the seller, so let's say the price fall below 48.5, I'm obligated to purchase 100 share of 48.5 here if I'm assigned. The max profit is 230, so this is a premium that I'm collected. For the max loss, okay, the max loss is 4620 because let's say Snap go bankrupt, it becomes $0, right? So I will lose all the amount. But you may wonder why, because I purchased 100 shares, my max loss should be $4,850, right? But why this one? Because we need to minus off the premium, okay? Because I will keep this premium, does not matter if I assign or not. So the max loss that I may suffer is 4850 minus 230. Okay, so it will be around 4620 here. The commission is 0.65, so my max profit will be 229.35. Okay, then the rest we can just then we can click send. Okay, that is it. Then we shall see if this will be filled or not. Okay, after I adjusted my selling price, like finally the option was filled at $2.10. Let's say Snap price is above $48.5 on 23rd of April, I will be collecting 210 premium. And if I manage to collect more than like 80% of the premium, I will consider to close this early. Yeah, so remember to subscribe my channel because I will update my option selling again and again here. Now, let us talk about the risk involved and how to fix the trade if the price is going against us. There are some information on YouTube or website saying that cash secured put strategy is a zero risk strategy, as we could either collect the premium or buy the share at the price that we want. However, I do not really agree with that. If the stock's price tanks far below the strike price that we sell the put option, we will still suffer a huge loss, as we do not know when the stock would recover, right? And some of them maybe never recover. Please also take note that if we do not manage our risk properly, one trade with a huge loss could wipe out a lot of profitable trades. Let us see what if the stock price falls below our strike price. First, assess what is the reason for the price drops. If the price drop is because of the normal retracement, I will take the following steps. First, if the stock price is at or slightly lower our strike price, we could just let it aside. In my case, once assigned, I will sell the covered call to continue collect the premium. I will prepare another video on the covered call. If you do not want to buy the stock because of other reasons, you could simply roll the option to future weeks. This would buy us more time for the decay and give us more time for it to expire worthless. If the price drops are very sharp because of fundamental issue, I would suggest to cut the loss. Please also note that a sharp drop or gap down of a stock could result in a huge loss to this strategy. Taken together, by doing a proper research and analysis, we could minimize the risk on cash secured put strategy and consistently earn pocket money weekly or monthly. The premium collected could either let us buy the shares for free or increase our profit. Please remember to subscribe my channel, as I will constantly update my journal on my cash secured put strategy. My aim is to collect enough premiums per month to replace my salary from my active job. Let me know if you need me to further clarify any part about the cash secured put strategy. I will be happy to help. Thank you very much and see you in the next video.